The global silver market is breaking, not in the way most people think, not with a dramatic crash or a sudden announcement, but through a slow structural fracture that has been building for years and is now reaching a point where the math no longer works. This is not about speculation. This is not about what someone hopes silver will do. This is about what the system is telling us when we look at supply deficits, industrial consumption curves, monetary policy constraints, and the behavior of the institutions that actually move metal around the world. The question we are examining today is specific. Can silver reach $300 per ounce by the summer of 2026? To answer that, we need to understand how the silver market actually functions, who the real players are, what incentives drive their behavior, and where the structural pressure points exist that could force a violent repricing. Because silver does not move like stocks. It does not follow earnings reports or quarterly guidance. Silver moves when the physical market and the paper market collide, and right now those two markets are telling very different stories. To understand where silver is going, you need to understand where it came from and how the current pricing system was built. For most of human history, silver was money, not a commodity, not an industrial input, money. The Roman denarius contained approximately 3.5 grams of silver. The British pound sterling was originally a pound of sterling silver. The United States dollar was defined by the Coinage Act of 1792 as 371.25 grains of pure silver. This was not symbolic. This was the monetary architecture of civilization for thousands of years. Silver was the currency of daily commerce while gold served as the settlement layer between nations. That system ended in stages. The crime of 1873 demonetized silver in the United States. The Bretton Woods Agreement of 1944 established the dollar as the world reserve currency backed by gold, with silver pushed further to the margins. And in 1971, when Nixon closed the gold window, the last tether between money and metal was severed. From that moment forward, silver became classified as a commodity, an industrial metal with some residual investment demand. Its price was determined not by its monetary function but by the futures market, a paper system where contracts representing silver could be created without any obligation to deliver physical metal. This distinction matters enormously because it created a gap between the price the paper market sets and the value the physical market demands. The futures market for silver, centered on the COMEX exchange, allows participants to trade contracts representing 5,000 ounces of silver each. The vast majority of these contracts are settled in cash. They never result in physical delivery. This means that the price of silver is largely determined by traders who have no intention of ever touching an actual bar of metal. They are trading exposure, not silver. For decades, this system functioned because there was enough above-ground silver inventory to satisfy the small percentage of contracts that did stand for delivery. The warehouses were full, the refiners had steady supply, the recycling stream provided a continuous flow of secondary metal, the system had slack. That slack is now gone. The Silver Institute, the primary industry body tracking supply and demand fundamentals, has documented 4 consecutive years of structural deficit. In 2022, the deficit was 237 million ounces. In 2023, it narrowed slightly to 184 million. In 2024, it widened again to an estimated 215 million ounces. And preliminary data for 2025 suggests the deficit exceeded 200 million ounces once more, 4 years of consuming more silver than the world produces. That cumulative shortfall, roughly 836 million ounces, had to come from somewhere. It came from above-ground inventories. COMEX registered silver stockpiles, the metal specifically earmarked for delivery against futures contracts, have declined substantially. London Bullion Market Association vault holdings have drawn down. The silver backing exchange traded funds has been steadily redeemed. The buffer that allowed the paper market to function without friction is evaporating. This is the point where most people stop analyzing and start speculating. They see a deficit and project a moonshot. But the system is more complex than that, and understanding the mechanism of how price actually moves is essential. Silver does not go from $90 to $300 because someone draws a chart pattern. It goes to $300 when the physical market overwhelms the paper market's ability to suppress or manage the price. That requires a specific set of conditions, and those conditions are now aligning in ways that have not occurred in the modern era of silver trading. The first condition is industrial demand that cannot be substituted or delayed. This is where the structural story becomes undeniable. Silver possesses the highest electrical conductivity of any element. It has the highest thermal conductivity of any metal. It has unique antibacterial properties, and it is essential, not optional, essential, in the manufacturing of photovoltaic cells for solar energy. Every solar panel produced in the world requires silver paste to create the electrical contacts that convert sunlight into electricity. There is no commercially viable substitute at scale. Copper does not have sufficient conductivity. Aluminum degrades too quickly. The solar industry has been working for years to reduce the silver content per cell through thrifting, making the silver lines thinner, using less paste per wafer, and they have succeeded in reducing the grams per cell. But here is the mechanism that most analysts miss. The total number of cells being produced is growing so much faster than the per cell reduction that aggregate silver demand from solar is increasing, not decreasing. The International Energy Agency projects that global solar installations will exceed 600 gigawatts of new capacity in 2026. China alone is installing more solar capacity than the rest of the world combined. India has committed to 500 gigawatts of renewable energy by 2030. The European Union has mandated 700 gigawatts of solar by the same date. Each gigawatt of solar capacity requires approximately 700,000 to 1 million ounces of silver. The math is straightforward. At 600 gigawatts of new installations, solar demand alone could consume 420 to 600 million ounces of silver in a single year. Total global silver mine production is approximately 820 million ounces. Solar energy is on track to consume between 50 and 70% of all the silver mined on the planet. And solar is not the only industrial consumer accelerating. Electric vehicles use significantly more silver than internal combustion engine vehicles. Each electric vehicle contains approximately 25 to 50 grams of silver in its electrical systems, battery management, and charging infrastructure. The 5G telecommunications build-out requires silver in every base station, every antenna, every connection point. Artificial intelligence data centers, which are now consuming the capital expenditure budgets of the world's largest technology companies, require massive amounts of silver in their server connections, thermal management systems, and power distribution networks. Amazon just announced $200 billion in AI infrastructure spending for 2026. Alphabet committed $185 billion. Microsoft and Meta are in the same range. The total announced AI capital expenditure from just 4 companies exceeds $650 billion for this year alone. A meaningful percentage of that spending flows through supply chains that require silver. This is the structural demand picture. It is not speculative, it is contractual. These solar farms are under construction. These data centers have broken ground. These electric vehicle factories are producing units. The silver they require is not optional. It is embedded in the engineering specifications of every product, and the orders are being placed not through the futures market, but directly at the mine level. Tesla, Samsung, and major Chinese solar manufacturers have begun sending procurement teams directly to mining operations, bypassing the COMEX entirely. This is unprecedented. When end users stop trusting the exchange to deliver metal and start competing at the source, it signals that the traditional distribution system is failing to allocate supply efficiently. The second condition is constrained supply with no near-term relief. Silver mining is not like turning on a faucet. Approximately 72% of silver production comes as a byproduct of mining other metals, primarily copper, zinc, lead, and gold. Only 28% comes from primary silver mines. This means silver supply is largely determined by the economics of other metals, not by the silver price itself. If copper prices fall and copper mines reduce output, silver production falls regardless of how high the silver price climbs. New mine development takes 7 to 12 years from discovery to production. There is no significant new primary silver mine expected to come online before 2029 at the earliest. The existing mines are maturing. Ore grades are declining across the industry. The average grade of silver ore processed has fallen by approximately 15% over the past decade. Mines are digging deeper, processing more rock, consuming more energy, and extracting less silver per ton. The cost of production is rising while the geological quality of remaining deposits is declining. Meanwhile, the recycling stream, historically the safety valve that balanced the market during periods of high demand, has gone quiet. Refiners report that the flow of secondary silver, old jewelry, silverware, electronic scrap has slowed dramatically. When the price was $25, people readily sold their grandmother's silver tea set. At $90, they hold it. At $120, they hold it tighter. This is a behavioral shift that reflects something deeper than market timing. People are losing confidence in the alternative. They would rather hold physical silver than convert it to dollars. This has happened before in the 1970s and briefly around 2011, and it always coincides with periods of monetary stress. Now let us examine the actors in this market and understand their incentives mechanically, not morally. The major bullion banks, specifically JP Morgan, HSBC, and a small number of other institutions, have historically maintained large short positions in silver futures. Shorting means they have sold contracts promising to deliver silver at a specific price. If the price rises above that level, they lose money. The Commodity Futures Trading Commission publishes a weekly report called The Commitment of Traders that documents these positions. Recent data shows that commercial short positions remain elevated, though some covering has occurred. The banks maintain these positions for several reasons. Some are hedging physical inventory they hold in vaults. Some are facilitating client transactions, and some, as documented in the JP Morgan spoofing case that resulted in nearly $1 billion in fines, are actively managing the price through concentrated short selling. The Department of Justice secured convictions against JP Morgan traders for manipulating the precious metals market over a period of 8 years. This is not conspiracy theory. This is adjudicated law. The question is not whether the price has been managed. The question is whether the institutions doing the managing can continue to do so as physical supply tightens. The mechanics of a short squeeze in silver are well understood because they have happened before. In January 1980, the Hunt brothers accumulated enough silver and futures contracts to corner the market. The price rose from $6 to nearly $50 per ounce in a matter of months. The COMEX responded by changing the rules, implementing liquidation-only trading that forced the Hunts to sell and crash the price. In February 2021, a smaller-scale squeeze attempt occurred when retail investors on social media coordinated purchases of the iShares Silver Trust ETF. The price spiked briefly, but the movement lacked the sustained physical demand to overcome institutional resistance. What is different now is that the squeeze pressure is not coming from speculators, it is coming from industrial consumers who need the metal for manufacturing. Toyota does not buy silver to make a speculative profit. They buy it because they cannot build a car without it. When industrial demand creates the pressure, the dynamics change fundamentally. You cannot convince Toyota to settle in cash. They need the physical silver, period. The monetary environment compounds every structural factor. The Federal Reserve cut rates throughout 2025, bringing the federal funds rate down to 3.50 to 3.75%. Real yields, the nominal interest rate minus inflation, have declined as inflation has remained sticky around 2.9%. Lower real yields reduce the opportunity cost of holding non-yielding assets like silver and gold. Meanwhile, the U.S. national debt has reached $38 trillion. Federal deficits are running at levels historically associated with recessions, not expansions. The Congressional Budget Office projects that interest payments on the debt will exceed $1 trillion annually. This fiscal trajectory creates a structural headwind for the dollar. Central banks globally have responded by diversifying reserves away from dollar-denominated assets and into gold. Annual central bank gold purchases have exceeded 1,000 tons for 3 consecutive years, roughly triple the historical average. Poland, China, India, Turkey, and Kazakhstan have been the most aggressive accumulators. The BRICS alliance launched a pilot gold-backed settlement unit in October 2025, backed by a 40-60 mix of physical gold and member currencies. Over 90% of trade between Russia, India, and China now occurs without dollars. The de-dollarization trend is not theory. It is measured, documented, and accelerating. And while gold absorbs the majority of official sector flows, silver has historically followed gold with a leverage multiplier. When gold moves 30%, silver typically moves 60 to 100%. This is because the silver market is approximately 1/15 the size of the gold market, so equivalent capital flows produce proportionally larger price movements. The gold to silver ratio provides critical context. As of this week, it takes approximately 55 ounces of silver to buy 1 ounce of gold. The historical average over the past century is approximately 50 to 1. The geological ratio of silver to gold in the Earth's crust is approximately 17 to 1. During silver's major bull markets, the ratio has compressed to 30 to 1 or even lower. In 1980, it reached 17 to 1. If gold remains at current levels around $4,700 per ounce, and the ratio compresses to 30 to 1, silver reaches $157. If the ratio compresses to the geological norm of 17 to 1, silver reaches $276. If gold continues to appreciate toward the $6,000 targets that Deutsche Bank and Bank of America have published, and the ratio compresses to 20 to 1, silver exceeds $300. These are not projections pulled from thin air. They are mathematical relationships based on measured ratios and published institutional forecasts. But we must also examine what happened this week because the market just provided a violent lesson in what the transition to higher prices actually looks like. On January 26th, gold breached $5,000 for the first time in history. Silver traded above $120. The precious metals complex was in what traders call a parabolic move, prices accelerating upward at an increasing rate. Then, on February 2nd, the CME Group announced an unprecedented 36% increase in maintenance margins for silver futures and a 33% increase for gold. Within hours, Kevin Warsh was announced as the nominee to replace Jerome Powell as Federal Reserve Chair. Warsh is perceived as hawkish, a signal that the era of easy monetary policy might face renewed discipline. The dollar index surged, and precious metals collapsed. Gold fell from 5,550 to 4,400. Silver dropped from 122 to approximately 83 in a single session, a 31% decline that represented the worst day in the silver market since 1980. Bitcoin fell from 83,000 to below 75,000. The Korean stock market dropped over 5% in a day. This event is being called the February massacre, and most people are interpreting it wrong. They see the crash and conclude that the bull market is over. But the informed observer sees something different. The crash was caused by three things. First, the margin hike forced leveraged traders to either deposit more cash or liquidate positions immediately. This is a mechanical event, not a fundamental one. The silver in the ground did not change. The solar panels under construction did not disappear. The supply deficit did not resolve. What changed was the cost of holding paper positions, and the leveraged speculators who could not meet the margin call were forced to sell. Second, the Warsh nomination signaled potential dollar strength, which is temporarily negative for dollar-denominated commodities. Third, the positions were overcrowded. Sentiment indicators showed that bullish positioning in gold and silver had reached 8-year extremes. The trade was popular, and popular trades are vulnerable to violent unwinds. But here is what the February massacre did not change. Central banks did not sell a single ounce of gold. The brick settlement infrastructure did not shut down. The solar industry did not cancel its orders. The supply deficit did not reverse. Mine production did not increase. New deposits were not discovered. Recycling did not surge. The structural foundation of the silver bull market remained completely intact while the speculative froth was blown off the top. This is actually the most bullish development possible for someone with a medium-term view. The weak hands have been flushed. The leveraged positions have been liquidated. The market has been cleaned of the speculative excess that made it vulnerable. What remains is the structural demand from industries that cannot function without silver, the supply constraint from mines that cannot produce more, and the monetary backdrop that continues to debase currencies against real assets. Deutsche Bank reiterated its $6,000 gold target the day after the crash. Bank of America stated that rallies do not end because markets are overbought, but because the fundamental drivers subside, and they see no evidence of the drivers subsiding. The physical premium over spot prices, the amount buyers pay above the official exchange price to acquire actual metal, widened during and after the crash. When paper prices fall but physical premiums rise, the market is telling you that the paper price is disconnected from physical reality. This divergence is the single most important signal in the silver market, and it is screaming. Now let us examine the scenario framework honestly. Because $300 is a specific number, and intellectual honesty requires assigning probabilities rather than certainties. The base case, which I assign a probability of approximately 40%, sees silver trading between $130 and $180 by summer 2026. In this scenario, the post-crash recovery follows a measured path, industrial demand continues growing, the supply deficit persists, and gold resumes its uptrend toward the 5,500 to 6,000 range. The gold-to-silver ratio compresses moderately to around 35 to 1. This produces strong returns for silver holders without requiring any extraordinary events. The accelerated case, which I assign approximately 30% probability, sees silver reaching $200 to $300. This requires the gold-to-silver ratio to compress to 25 to 1 or below, which historically only occurs during silver's most intense bull phases. It also requires gold to reach or exceed $6,000, which multiple major banks have explicitly forecast. The catalyst could be a delivery failure on the COMEX, where a significant number of contract holders demand physical silver and the exchange cannot provide it. It could be a geopolitical escalation that drives safe haven demand beyond what the market can absorb, or it could simply be the accumulation of monthly deficits reaching the point where above-ground inventories are functionally depleted. When available supply hits zero, price discovery becomes purely a function of what buyers are willing to pay. The suppressed case, probability approximately 20%, sees institutions intervene aggressively to cap the silver price. Further margin hikes, regulatory changes, potential trading halts, or coordinated central bank action to defend the dollar could delay the repricing. In 1980, the COMEX changed its rules mid-game to crush the hunts. Regulatory intervention is not a theoretical risk, it is a demonstrated historical pattern. In this scenario, silver trades sideways between $80 and $120 for an extended period while the fundamental deficit continues building, setting up an even more explosive move in 2027 or 2028. The black swan scenario, probability approximately 10%, involves a broader systemic crisis, multiple exchange defaults, a derivative cascade, a major bank failure related to precious metals exposure, or a sudden loss of confidence in the dollar that triggers a rush into hard assets at a pace the market cannot absorb. In this scenario, the silver price becomes temporarily meaningless because physical metal becomes unobtainable at any quoted price. The paper market ceases to function as a price discovery mechanism, and the premium for actual silver in hand becomes the only relevant number. This scenario sounds extreme, but elements of it have occurred historically, and the derivative exposure in the current financial system, estimated at over $1 quadrillion notionally, creates interconnected risks that are poorly understood even by the institutions that hold them. There is another dimension to this analysis that connects every factor we have discussed. The relationship between energy policy, monetary policy, and silver demand creates a feedback loop that most analysts examine in isolation, but which functions as an integrated system. Governments have mandated the green energy transition. That transition requires silver. The silver must be mined, which requires energy. Energy costs are rising due to geopolitical disruption and the transition itself. Higher energy costs increase mining costs. Higher mining costs require higher silver prices to justify new production, but higher silver prices increase the cost of solar panels, which are the centerpiece of the energy transition. The energy transition that creates silver demand also constrains silver supply, while simultaneously increasing the cost of the transition itself. This is a circular pressure system with no obvious release valve. The Federal Reserve sits at the center of this system with an impossible mandate. If they raise rates to defend the dollar and control inflation, they increase borrowing costs for the government, which is already paying $1 trillion a year in interest. They also slow the economy, reducing tax revenue, widening the deficit further, and requiring more borrowing, more debt, more interest payments. If they cut rates to support the economy and reduce debt servicing costs, the dollar weakens, commodity prices rise, inflation returns, and the cost of the energy transition escalates further. There is no policy path that resolves all of these tensions simultaneously. The system must adjust through price. And silver, sitting at the intersection of monetary demand and industrial necessity, is one of the assets through which the adjustment is most likely to express itself. The informed observer does not watch the silver price. The informed observer watches the inventories, the delivery requests, the physical premiums, the mining cost curves, the solar installation rates, the central bank reserve allocations, and the fiscal trajectory of the nations that issue the currencies in which silver is denominated. All of these indicators point in the same direction, not because of conspiracy, not because of manipulation, not because someone on the internet drew a line on a chart, but because the mathematical relationship between supply and demand has reached an inflection point that the pricing mechanism must eventually reflect. Can silver reach $300 by summer 2026? The honest answer is that the structural conditions are in place for such a move, the historical precedents exist for ratio compressions of that magnitude, and the institutional forecasts for gold provide a framework within which $300 silver is mathematically consistent. But honest analysis also requires acknowledging that markets can remain irrational longer than individuals can remain solvent, that regulatory intervention has historically disrupted precious metals rallies at precisely the moments they threaten systemic stability, and that the timing of structural moves is inherently uncertain even when the direction is clear. What is not uncertain is the direction of the structural deficit, the trajectory of industrial demand, the constraints on new supply, the fiscal position of the world's major economies, and the behavior of central banks. These factors do not argue for lower silver prices. They argue for a repricing that the system has been deferring through inventory drawdowns and paper market mechanisms. The question is not whether the repricing occurs. The question is whether it occurs gradually, through a steady grind higher as inventories deplete, or violently, through a delivery crisis that forces the paper price to catch up to physical reality in days rather than months. The people who run the mining companies know this. The people who run the solar panel factories know this. The people who manage central bank reserves know this. The institutions that have been accumulating physical metal while simultaneously maintaining paper short positions know this better than anyone. The information is not hidden. It is published in industry reports, documented in exchange data, confirmed in corporate procurement strategies, and validated by the behavior of every major actor in the system. The signal is clear for those willing to read it without emotional bias in either direction. This is not financial advice. This is a structural analysis of a market where the fundamental inputs are measurable, the historical patterns are documented, and the current trajectory is mathematically unsustainable at present price levels. What each person does with this analysis is their own decision, informed by their own circumstances, their own risk tolerance, and their own assessment of the probabilities we have outlined. But the system is speaking. The inventories are declining, the deficits are accumulating, the industrial demand is contractually locked, and the monetary backdrop is deteriorating in ways that favor hard assets over paper promises. The question that actually matters is not whether silver reaches $300. The question is what the movement of silver tells you about the health of the monetary system that prices it. When a metal essential to the technological infrastructure of modern civilization cannot be supplied in sufficient quantities at current prices, and when the institutions that set those prices are demonstrably short the physical commodity, the price is not reflecting reality, it is deferring it. And deferred reality, in markets as in life, eventually arrives, usually all at once, usually when most people are looking somewhere else. The flow of money is moving. The question is whether you understand where it is going and why.